Imagine this. Imagine you find the home of your dreams. Imagine you negotiate with the seller to sell you this home for 5% below asking price, and then all of a sudden your bank tells you you don't qualify. Your dreams are crushed and you feel embarrassed. You've already told your friends and family about this awesome home that you found and you're moving into, and now you're going to have to rent again. Unfortunately, this happens every single day to home buyers across America, yet some are introduced to experienced mortgage professionals who can show them how to properly navigate mortgage financing and can turn a bank's no into a yes. On today's episode of Talk Mortgage to Me, our creator and host Dustin Owen is going to be sharing a real-life example about how his team recently used creativity to save a transaction as well as lower the monthly payment. But what's crazy about this particular scenario is that the home buyer ended up paying more for the home but found a lower monthly payment. And most importantly, we were able to qualify for the mortgage. I'm Karina Mojica, and this is Talk Mortgage to Me.
The particular scenario that we're going to cover today is so common. It is so common because people think that there is a thing called a one-size-fits-all mortgage. And mortgage financing could not be any further away from that truth. Mortgage financing needs to be customized. Mortgage financing is not one-size-fits-all mortgage. A good lender, whether it's a mortgage broker, a loan originator, a VP of lending, whatever they want to call themselves these days, is somebody that's going to customize or tailor-make financing to match your specific needs, wants, and goals. Sometimes the lowest interest rate actually is the worst loan structure. Sometimes the lowest interest rate is actually the higher monthly payment. And this is something that the national media doesn't talk about. You're not going to go on Yahoo Finance or Bankrate.com and read articles that get this technical. So the scenario that Karina just prefaced, or the scenario that Karina just talked about, that she teed up for us, it's a real life scenario. So let me walk you through exactly what happened. Yes, this was a couple. They were in their late 30s, but they were buying their first home. They were super excited. They were very proud. Credit's good. Income is stable. It's a dual income household situation. They had money for a down payment. So to them, this was the moment they had been dreaming about for over a decade. And it was over a decade because they've been married 10 years and they've been looking forward to this opportunity since before they were even married. And here's what happened. They found their house. They then went to their bank and they tried to apply for a loan. Now, learning lesson number one, that's a little bit backwards. Learning lesson number one is that you typically go to your lender. You discuss your financial needs, wants, and goals. You talk about comfort monthly payment. You discuss how much money do you have allocated to go towards a transaction? And then is that money enough or is that money too much? Are there other ways that we could leverage that money to allow you to become a homeowner, allow you to match your financial needs, wants, and goals, but also put you in a position to be better off financially after you purchase the home? So this couple, if there's something that they could have done better, they could have gone to the lender first. They didn't. They found the home, they fell in love, they went to their bank, and they're like, look, we're ready. We have great credit. We have money to put down. We both have jobs, and those jobs are stable and they produce income. So let's get ready to rock and roll. And to make things even better, they found a home that was originally listed for $400,000, but they're going to get this home for a lot closer to $380,000, so 20 grand off. So they're super stoked, and you would be too. But when the banker at the bank tried to do a loan for them, he couldn't qualify them. Their debt to income ratio was too high. Now, granted, some of their income couldn't be used to qualify because it wasn't guaranteed and they didn't have a history of it. So in their minds, they're making this money because he just got a promotion. That promotion comes with some bonuses that he wasn't otherwise receiving in previous years, but those bonuses weren't guaranteed. Those bonuses didn't have a track history. So therefore, it was money that couldn't be used to qualify. They also had a car lease that, because it was a lease in their mind, They didn't think of it as a debt the way you would a car payment or a student loan payment or even a credit card payment. So they had a little bit more debt than they anticipated, and he brought in less guaranteed money than they thought, which made it difficult for them to finance. So they thought, oh my gosh, I'm going to have to go back and tell all of my friends and all of my neighbors that I was super excited about telling that I was going to buy a home that I now can't, and then explain to them why. How am I going to tell my family? What does this mean to everyone else in our ecosystem? What does this mean for us? What does this mean for our marriage? But luckily, the realtor was like, hey, I have this girl that I've been working with for the past decade, and Jessica is amazing at what she does. She has actually pulled rabbits out of her hat for me before. Why don't we talk to Jessica first? Let's not alarm the sellers, and let's see if there's a better way forward. So they go to Jessica, and Jessica starts asking all the right questions. She asked the realtor, hey, if you bought this home for $400,000 and not $380,000 because she saw it was originally listed for $400,000, do you think it would appraise? And the realtor's like, I think this thing will appraise for $405,000, maybe even $410,000. Jessica's like, okay. And then she went to the buyers, and she said to them, if I could free up some of your money, would you be willing to buy out your entire lease? Right now you're leasing this car, the lease payment's $300 a month. How much would it take for you just to buy the car outright? And then from there, she went to work. And here's exactly what Jessica was able to do for this couple who's buying their first home at the age of 38 years of age. She went and she said, look, pay $400,000 for the home. However, I want you to ask the seller for a $20,000 seller credit. Originally, this couple was going to put down 20%. Like I said, they've been waiting for this opportunity. But even with 20% down, their payment was going to be too high for their debt to income ratio. So Jessica says this, instead of you putting 20% down on $380,000, I want you to put 10% down on $400,000. So instead of them putting down roughly $76,000, let's go ahead and let's put down $40,000. That frees up $38,000. On top of that, she says, we're going to go to the seller, and the seller is going to give you a $20,000 closing cost credit, right? The difference between the $380,000 and the $400,000 is $20,000. The seller's not going to net any more money from this transaction, but it frees up $20,000. And in return, Jessica says, here's what we're going to do. Because you're putting 10% down and not 20% down, you're going to have mortgage insurance. Instead of you paying mortgage insurance out of your pocket as a part of your monthly payment, we are going to use a seller credit, that $20,000 that the seller is using, and we're going to use that money to buy out your mortgage insurance. The next thing we're going to do for you is we're going to use the seller's money to pay all your closing costs. Originally, you're going to put down 20% and you're going to have to pay another $10,000 in closing cost. We're going to use the seller's money to pay your closing cost. We then are going to use the remaining money that's left over from the seller credit, and we're going to drop your interest rate 1 whole percentage point. Now, all of a sudden, let's say rates were at 6.5%, their rate's going to be 5.5%, which saves them about $300 a month. So yes, their sales price went up. Yes, their loan amount's a little bit more. The home's going to appraise for the $400,000, maybe even more. They now are only going to come out of pocket $40,000. Instead of before, they're going to put down 20%, which was $76,000, plus they needed $10,000 for closing costs. So instead of $86,000 out of pocket, they're going to put $40,000 out of pocket. They then are going to take some of that money and they're going to buy their car outright. You see, one of the problems was that lease payment on that Tesla, because by the way, it was a Tesla, that lease payment on the Tesla, when included in their debt income ratio, was making their ability to qualify non-existent. Well, if they own the car outright, then they don't have to use that payment against them. And to make matters even better, they're going to have more money left over after closing so that they have that reserve fund, that rainy day fund, that, well, what would happen if my home were to break, or when I need to fix something or repair something in my home? They have that. And the best part is because they have a lower interest rate, even though they have a slightly higher loan amount, their mortgage payment is actually a little bit cheaper than it would have been. So this is a win-win-win all around. It's a win to the seller because the seller just avoided a buyer being denied. It's a win for the realtors who worked so hard to put this transaction together. They get to hold it together. It's a win for Jessica because these clients didn't even know she existed prior to their bank turning them down. Jessica got an opportunity to perform. More importantly, she saved a deal. She got to be the hero. And then for the home buyers, they got exactly what they wanted. A home of their own, a place to raise their family in a place that they can be proud of, something that they can share with their friends and family in a way to generate the greatest amount of wealth and accumulate the greatest amount of wealth. They didn't care about sales price and loan amount. They cared about, do I have enough money to do what I need to do financially? Is the payment something I can afford? And am I paying a fair price for this home? Yes, they paid a fair price for this home. They got the home for a little bit under appraised value. They were able to get the seller to work with them to allow them to only put 10% down, but pay no closing costs, to put 10% down and have no monthly mortgage insurance, and to put 10% down and to achieve a discounted interest rate, all by leveraging a seller credit. And if there was a moral to this story, it would be this: don't take a no as a no forever. Take a no as a, you can't come up with a solution, but maybe someone else can. Remember and understand there's no such thing as a one-size-fits-all mortgage. Understand the power of leveraging a seller credit to make homeownership more available as well as more affordable. At the end of the day, home buyers want a home. They don't want a mortgage. Most of us dream about never having a mortgage, but we do want a home, and it's home ownership that statistically over the past century, home ownership is the reason why people are able to create generational wealth, whereas if they never owned a home, they couldn't have done it. If you have a situation that sounds like this, or even a situation that you think needs a second opinion, do yourself a favor, reach out to us. That's what we're here for. We create content like this for the loan originators, the realtors, and the home buyers who need a resource and a source. If you send us a message, if you comment below, a member of our team will get in contact with you. And more importantly, they'll get you in front of a TLOP approved professional. I'm Dustin Owen, along with my co-host Karina Mojica. You have just tuned in to Talk Mortgage to Me. If you like content like this, subscribe to our YouTube channel and share it, because sharing is caring.